Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. Now, I wanted to start today's show with addressing my recent video over the weekend. It was a special report on my disagreement with Lynn Alden's idea that we are in a fiscal dominance situation. I think the thing I need to say the most is calling it, I think she just is mislabeling it. If you look up what fiscal dominance is, it's an extreme situation. And if we are headed into a fiscal dominance situation, that's really bad. I mean, like, could be end of the world kind of bad. But the thing is, we are not there yet. I mean, she thinks we're closer to that situation than I do. But, enough with opinions. Let's look at the data here. First, she has been saying, the interest as a percent of GDP is getting out of hand, but it's not even at historically high levels. And I don't know what the highest amount is before we might be in a fiscal dominance kind of a scenario. But as you can see, we peaked in 1991 at 3.2%, and today we are only at 2.4%, all while the Fed is still talking about cuts. I mean, we're pausing, we're staying here. They know it's restrictive enough, and then when the cuts come, this is going to go down. Okay, how can it keep going up? I get it. The amount that we're spending per year is higher than the tax receipts, but even that has to be taken with a grain of salt. Gains in the stock market, the fact that things are going up so much in price, it means that there's going to be more taxes paid as well. This isn't just like all the money's disappearing. Things have a balance to them. Let me show another chart here. So this one is the federal government budget or budget surplus or deficit. And I just want to note that in Q2 of 2022, we actually were at a surplus for the quarter. Now, the cumulative deficit, no, we were not overall in a surplus. What it means is that we declined the amount of cumulative deficit. So let me show another chart. Here is a chart of the overall cumulative federal surplus or deficit. As you can see, if you remember in the dot-com era where we had the big bubble and all these tons of taxes coming in, we were at an actual surplus of about 200 million. Now, yeah, in 2020, we ended up with a $3 trillion deficit, and then 2022, we went all the way back up to only 1.3 trillion dollar deficit. And then in 2023, we have a slightly deeper deficit of 1.7 trillion. Now, going back to this chart here, I just want to note out just a little pattern here. Like, this isn't that hard to find or that hard to see. Typically Q2, by the way, you get the overall surplus or deficit. The surplus comes in because that's when I believe a lot of taxes come in Q2 because of the tax day is in April, right? So that's Q2. So, Q2. Okay, so then we have in this chart here, we have a higher low in 2022 and a higher high. So who's not to say that this is going to continue, that we're going to see another higher low, higher high, and continue upwards. As you can see, this chart here, this is generally is very wavy and goes up and down around zero, or sometimes we're in a surplus, sometimes a deficit, sometimes surplus, sometimes a deficit. And to make the claim that we're just headed into infinite deficit territory and we're never going to come back, as the world reserve currency, I mean, really? This is the end of the United States? Well, where else are you going to go? I mean, the best of bad money, define it whatever you want. You know, most of the world's debt is in dollars. At the end of the day, everything is priced in dollars. Everything that people care about, you care about how much is it worth in dollars. At the end of the day, that's the question they have, including gold, by the way. So I think calling it, I don't even know if she means to fearmonger in this way, but we're not seeing a fiscal dominance situation now, not yet. Back to the regular scheduled program. Today is Monday, April 22nd, 2024. This week we do have important data coming out. We have the Purchasing Managers Index. If it's under 50, it means we are in a contraction. That will mean that rates can go down if this ends up being below 50. Thursday, we have GDP coming out. See if GDP is strong, that means the economy is strong. If it's down, then chaos ahead. And PCE, personal consumption expenditures, coming out on Friday. This is all very important data, especially in these times where we have rates flipping back and forth. Like, are we going to have a cut in June, July, May? It's like, it's crazy out there right now. On to the charts. One of the most notable charts today that I found was actually in silver. We had a move down 5.6%. The cost of silver dropped by 5.6% today. That's a very large move for the price of such a staple, huge commodity. I mentioned in a previous show how I had gotten out of silver. I think I got out of silver in March because of the fact that I'm looking at a more historical value of it, and I can't be too excited about it because at this price right now, overall, it's too speculative for me. It's not obviously cheap to me. I will get into silver if it becomes obviously cheap. And for me, if it's under $20, I'm interested. I'm a little interested. I need to see it. If we get down to around, I mentioned in a previous video, $11, I believe was the number I was looking for, an ounce of silver, then I'm really interested. But at 28, yeah, I mean, it's a game of hot potato, musical chairs, whatever you want to call it. Moving on to the S&P 500, I had mentioned the three black crows that we had seen, and finally where we look like we have an expected bounce. Now, in a bear market, we expect bounces. I do expect this to continue as a bear market. Now, looking at the daily, again, we had been, in fact, 1, 2, 3, 4, 5, 6, number 7. One of the things that Gareth talks about in other traders is the magic number 7. And you gotta remember that markets are psychological. At the end of the day, there are people behind what happens to the prices of things, and one of those spooky numbers. And yeah, so we finally have our bounce. Will we? What happens from here? Can we bounce higher? Of course we can. I do think that we are I think we've peaked out, and I think we are headed into a secular bear market. Why do I believe this? various reasons. Number one, we're at that part of the cycle where the Fed choked the economy and they said, you know what, we choked it long enough, but we're not actually going to let our hands off yet. They're still holding on to the neck of the economy. It's really important to remember that. And on top of that, just the valuations of stocks have gone, they've gone too high. They've gotten ridiculous. The cost of borrowing is high. You know, this is not a demand-driven inflation. This was a fiscal-driven inflation, inflationary bump, I'm gonna call it. Overall, aging population, you know, the Fed had been seeking more ammo in order to have more time to reduce rates moving forward, and they got that, and I think that's exactly what's playing out here. I don't think that story's changed. Looking at the fear and greed index, still in fear mode. Now, from this point, it was interesting. We had gotten to neutral, to greed, back down to fear, I think maybe back to greed, and then back to fear again, and now, are we going to end up back in greed? I think we're going to stay in neutral and fear for a while here, and I think this is going to turn into a longer, larger bear market, as I've been saying. The dollar shows some evidence of that, actually. This is obviously a bull flag here, so in other words, we have green pole here and then sideways consolidation. This looks like it's most likely going to break out higher. HYT had a nice bounce today. I talked about as well, high yield corporate. This is, how risky is it for smaller companies? How risky and expensive is it for small companies to be borrowing money? And wow, we had such a recovery here. I didn't think we'd even bounce this high. I don't expect to get to new highs, especially. I think we could even get to the maybe bottom of the first black crow here, and then turn over again. I'm a bear. I'm a bear right now. One of the things going against me, maybe we look at the VIX fear index based on options contracts pricing. I want to just point out real quick, we had a very clear higher high, higher low, higher high, higher low, higher high, higher lower low. So this is no longer in a very clear uptrend, which this is probably the chart that surprised me the most. I think that because of my overall view that the market's headed lower, I don't think we're going to get down again to lower lows. In fact, what it looks like to me is most probable situation is for us to maybe go back down to this line that we've been bumping on and maybe go up from there. Next, I want to bring up TLT. This is a largely zoomed out chart. Where my mouse is right now is in 2020, beginning of 2020, before we had all the craziness begin. And I just want to draw a pattern here. This is like we go up a little, we go down further. We go up a little, we go down further. We go up a little. Are we going to head down further? I just want to remind everybody that the lower this gets, the more pressure it puts on businesses. The more expensive, the lower this goes, the more expensive it is to borrow money. Mortgage rates, if you think they're high now, if this keeps going down, mortgage rates go up. It's just how it works. I don't expect that to happen here. I think we've bottomed out in TLT, and I think this is one of my favorite places to be. Obviously, I've been talking about it. I'm about 45% of my portfolio in this fund right now. And yeah. But the pattern that, that I'm showing here, when does it end? It's not like I'm the guy with the crystal ball. Another longer term chart I wanted to bring up, well, let's say I am wrong and, well, rates are high and they stay high. One of Lynn Alden's arguments here is, she's a big believer in metals. Being in a secular bull market through this period, along with, when you have yields going up, you typically have oil going up and metals. And REMX, if she's right, well, I have this fund. I'm looking to increase my allocation to this. Actually, I did today. I increased it from, I think it was 1.6% to about 2.5% of my overall portfolio. And I just want to mention, the value of these companies producing rare earth strategic metals, including lithium, was valued in 2011 at $330 a share of this ETF, and we are sitting around only $49. This is one of those areas that Graham would probably say is a long underinvested area. And if there's a time to get into this, I see this as a great opportunity. Now I'm going to mention I looked at this thing compared to the S&P 500, and more than anything, it seems like this has more beta than anything else. And so, in other words, when the S&P 500 goes up, this goes up more. And when the S&P 500 goes down, this goes down more, generally speaking. However, the downs have been a lot more pronounced than the highs for so long that I think that it's a time for maybe this trend to perhaps reverse. Now, if the S&P continues to go down in value, it's not unexpected for this to continue lower along with the S&P 500. But overall, this is, any way that you look at it, I am more excited about this market than other markets at this point. The PE ratio, by the way, of this fund is around 5, which is very low. In other words, for every $100, it's making $20. It's making, a dollar. The cost of earning $1 is $5 for this fund. Granted, it's really only because these companies have been able to make a lot of money very recently because of the price of metals going up so dramatically. And so for it to stay at 5 is not like expected. But, the value of this fund from this current price has to double just to get to a current PE ratio of 10. And yeah, it's just one of those areas that I'm more excited about. If the market continues lower with this going lower, I'm looking to invest actually about a 5 to 10% portion of my portfolio into this fund, REMX. One more chart that I found to be more interesting today, KWEB, KWEB. This is like Amazon, JD, the Amazon and Facebook and stuff of China. So they have JD, Baba, Tencent, etc. And I just want to mention, first of all, we've been in this sort of wedge pattern since the beginning of 2023. And again, from a longer term viewpoint, the value of this fund itself, around $26, before COVID, we haven't seen that price since, it was bottoming around this price as far back as 2013, 2015. This is way overdone. This is another area that I think has too much fear, and investors will eventually realize there's more value here than what's priced in. And along with this pattern of a wedge, if we break out here, we could see, I think we could easily, very, very easily get back to a more normal range of maybe between $40 and $50. But who knows? It's not like I'm the guy with the That's all I have for you for today's show. I hope you enjoyed, and thank you for watching. Robschild.